Hey, we want to welcome everybody to a very special coffee break, which also happens to be a coffee with your coach, a very exciting Masters themed episode. And I think that we've come up with great titling for this. This is where we're either going to get groans or cheers from the other side of the table. What about mastering the market volatility while playing in the rough?
It's rough.
I like
rough.
There
You
you
like
go.
it?
I like
You
to
know-
play through the rough.
Just like in golf, navigating the financial fairways requires skill, strength, strategy. Want to make sure that all those things are considered, and most importantly, sometimes the use of a good caddy,
Caddy.
Caddy.
our coach in this area, if you will. And if you won't, hey, listen, do me a favor, coaches, caddies, grab your Arnold Palmers. We're going to leave the pimento sandwiches for later, and let's get ready to start and talk about a deep dive into how to keep our retirement game on course.
Well, I love it. And, I love the theme, especially with, we are right here about to enter into Masters season,
That's right.
And it's a big deal, especially we're here in Metro Atlanta, and as we start to think about, what these players do to really win and succeed, I think we've outlined a really great, time together for our audience, in which we're going to tackle the things that we should be thinking about in the midst of this market volatility.
Yeah.
If you're here with us on a break, you know these coaches, but if you're here with us on the YouTubes, I want to make sure that you're aware with us today behind the clipboard, but also on the fairway.
Oh, rarely.
Nice.
Rarely.
Nice.
Randy, thanks for being here.
Thanks, Aaron.
Nick, thanks for being here.
Yeah, glad to be here.
I'm Aaron. You're a caddy for the day. Okay, so these are some things that we kind of had listed that we wanted to go over during our coffee break today. We want to touch on these things during the episode. We want to talk about understanding market volatility and its historical context. We want to talk about the impact of tariffs and Federal Reserve rates on the economy. I don't know if you've heard anything about these tariffs.
Somebody
Can you
mentioned
spell it?
Yeah, right. Strategies to manage your retirement portfolio amid uncertainties in the rough. And we want to have three key takeaways, Nick, at the end. We're going to, normally it's the key takeaways. It's going to be the 3-stroke par for today's episode to close us out. But the first thing I want to do is I just want to kind of open up, with that understanding. The thing about it is we always talk about seek first to understand, right? That's the moment right now. In golf, every course has its challenges. It doesn't matter, if you're familiar with it, unfamiliar with it, there's going to be something that's going to either elevate your game or show you exactly how humbled you should be. It's things like the bunkers, the water hazards, unpredictable dog legs, weather that you can or cannot plan for. Similarly, the market has its own obstacles. There's volatility, there's economic shifts, policy changes. We've talked about that a lot recently. Nick, can you shed some light on how often the market experiences these hazards and, still finishes strong?
Yeah. I think it's, a great kind of, I love the analogy that we're really kind of using with golfing today because, even the most seasoned pros are going to have an occasional bogey or double bogey, right? I mean, Tiger Woods, Phil Mickelson, like it doesn't matter. Like they're all, Rory McIlroy, like they're great, incredible golfers.
Yeah.
But even, I know they don't necessarily visualize it, but for them to get a bogey every now and then or a double bogey, I mean, it's
Right.
going to happen.
Right.
Same thing with the market. I mean, for us to be long-term investors and not expect an occasional dip, I think that's missing the boat. These market dips, regardless of what the outside influence might be, are just normal.
Yeah.
Now, if we were to frame this in a historical context, on average, we could expect entry year to have a 14% dip, and that be considered normal.
Sure.
But we also know historically, excuse me, in those years, approximately 75% of those years end positively.
Yeah.
So I think the key takeaway is that even if you have a tough hole, you can still recover on the rest of the course.
Yeah. Yeah. And it's funny, we're talking about the rough and like people are thinking about Augusta and like even the rough there is pretty well maintained. So your rough may vary, but if you find yourself in the rough, don't give up. It's about smart play, being tactical and getting back on the fairway or the green. I think we need to talk about some of the current conditions. We mentioned that in our analogy at the front. And I think at least what I've been hearing a lot recently in review meetings and appointments and stuff like that, people want to know about our thoughts and ideas on the tariffs. So could we take just a minute to talk about, the Federal Reserve maintaining the higher interest rates, discuss tariff and impact of tariff just a little bit. because these are factors that can influence the market. Randy, could you cover that for us?
Sure. First of all, as I'm thinking about this whole coffee break that we're doing today, and I'm thinking about my golf game, and I'm thinking how applicable it is to the market, and that is if I can relax. I don't play golf very often, but if I can relax, I just hit the ball a lot better. I have a much better day.
Yeah.
But what I tend to do is, especially if I'm with really good golfers, is I tend to really get tense and it messes up my game.
Yeah.
So I think what we need to understand, what are the tensions? What are the things that we need to think about and put them in line with what Nick said? And one of them, as I've heard Nick say many times, the market likes liquidity and certainty. And right now we have neither.
Right.
And so as a result of that, we should anticipate that we're in the rough. But, a good golfer has to play in the rough, and a good golfer has to be able to analyze the situation. And I was talking about, as I've gotten older, I'm wondering how good my swing is, like how far I can get back in that. And one of the things a good golfer told me is that, if you ever watch old guys that play a lot, they don't have a really great swing, but they stay in the green. And I think that's an interesting part of the game. So right now, what we have to do is we have to little time go by. A great example of that is today, yesterday and today, where we had anticipate the closer we get to understanding the tariff, what that's going to be, how aggressive it's going to be, et cetera, you would anticipate that the market would be really bad right now. Right. And of course, it started out in the red, and today it's back in the green, and in the green pretty well. And that just shows you how counterintuitive investing is. And maybe I could share a little bit more about that later, but just recognize what we're doing, what we're playing. You are in the rough right now, and you've got to trust your clubs. And in our case, you got to trust your indicators, trust the tools that we use as investment advisors and as portfolio managers to get us out of that rough.
That's such a perfect analogy, because overpowering it can be a problem, overcorrecting can be a problem, and those right tools are in golf. Choosing that right club and reading the lie is important. Randy, thanks. I appreciate that.
Well, a good caddy will help us with that.
Hey, good coach. All right. So listen, in golf, having that right club is essential for the shot. And similarly, in retirement planning, having the right portfolio or strategy can also make that difference. And Nick, I'd love for you to kind of talk us through, we talk with our clients a lot. We've mentioned on the podcast before, the now, future, and later bucket strategy that we appeal to.
Yeah. We've worked with clients in retirement. We have seen what works and what leads to successful retirement income. I mean, hundreds and hundreds and hundreds, if not thousands of people that we've walked this journey through.
Right.
And so kind of knowing what works, do what works. And what we've seen work over time is really having those portfolios structured for now, later, and future. Okay. So this whole idea of a now portfolio, it allows for us to sleep at night. If one of the big objectives of that portfolio is try not to lose money, keep liquidity and safety, and give a dependable paycheck each and every month to a retiree, that's a great portfolio to have. And if you fill that for 3 to 5 years, it gives you a lot more confidence to go through these down markets where you've got so much uncertainty around you.
Yeah.
So that now portfolio is almost like your putter, right? It's that short distance club where you're trying to make sure that, that club's enough to get the ball into the hole. So we want to make sure we never run out of money. So you have to have the right portfolio for that. The later portfolio, I almost equate it to like a 7-iron. I could use it, just about anywhere on the fairway, right? Especially with my golf game. But it's dependable. We can extend the life of that portfolio. Sometimes we, bend it a little bit more towards, future income needs, or like most of our clients, really what it's doing is it's designed to take profit, it's designed to take dividends and interest and a little bit of principal sometimes. It's designed to take all of those elements and ultimately refill your now portfolio so that through your retirement life, you always have a now portfolio. And one of the things our clients are able to do so successfully in seasons like this is really weather these storms because they're much more confident because they have that now money safe and secure.
Absolutely.
And then you've got the future portfolio. And I would equate that to your driver. Okay. We want distance and we want to go. We're putting that ball way out there. So, I mean, that's a 10-year plus portfolio. And the reason that you're in retirement and you still have that is because we're living longer than we've ever lived. We've got to make sure our money, it lasts at least as long as we do. We don't want to be in our kid or grandkid's basement one day, right?
Yeah.
So we want that money to last. And we've got to keep up with two of the biggest killers of your money: taxes and inflation.
Right.
And those are very real destroyers of money. That's why we have to have that growth portfolio. So right now you've got growth portfolios that are suffering much more under the volatility. But that's not the that's not the portfolio that's given us the checks every month.
Right.
So it allows for us to temper the concern.
I love that. So, Nick, for our listeners and our watchers that have only played putt-putt, there's more than that one club.
There's more.
No, I think that's so good. You know, Randy, you alluded to it earlier. Sometimes when we go out on the course, you see a player that squats down and they're kind of looking to say where the lie and the fall is, and they'll consult with a caddy that goes to another angle. I know that our team has been watching the markets. You've kind of been leading us in some updates here recently and kind of working through some stuff. Could you shed a little bit of light on kind of what you've seen and what kind of strategic adjustments may or may not take place in a volatile market like this?
Well, I think one thing I always think about is the things that we look at are fact-based, and I've noticed that what's happening in our society today, and it happens on the golf course, but it happens in real life. And that is that we've structured things in such a way that the media understands this. So if you're watching any network or cable television, the focus groups have determined that if there's a lot going on, like if you take a look, and forgive those of you who are in Chicago, from Chicago, if Chicago, there's 30 murders over the weekend, we become a little numb to that.
Desensitized.
Absolutely.
Desensitized,
Yeah.
right? But if they could take one case, and again, recently we're hearing a lot about the lady that drowned in
Dominican Republic.
Dominican Republic, exactly.
Yeah.
And like there's like 6 and 11.
Yeah.
Because what we got to understand, and this is true of investing and the things that lure us outside of a sound strategy,
Yeah.
is that if we can get their attention in the media, they can sell advertisement.
Yeah.
So if you could sell advertisement, that's the number one goal. And we have to realize that whether it is politics or the market, they want you watching at 6 and 11, and they can't say just write it out. They can't say this too shall pass. They've got to get your attention and get your interest so that you'll watch.
Yeah.
Unfortunately, over time, what that does is makes you hypersensitive to what's going on. That leads to the second point I want to make, which is investing is counterintuitive. And that means your natural intuition, which could be steered by all the stimulus that we're getting, is typically wrong. All the folks that study behavioral finance suggest to us that your intuition when it comes to investing is wrong. When you combine that with other things like hindsight bias, when we see something go wrong, we think, well, I knew that, but you didn't know that. You had to play the game. So let me give you an example which relates to golf in my mind. One is, again, I don't play very often, but I do know that my eyes will deceive me. And I have been on the green, and I have been in the fairway, and I've taken a look, and I am way off. Like the club I'm going to use, the direction I'm going to go, the way I think the green lies, and a great caddy or coach who has experience, who's played that, maybe that hole before, maybe 100 times, can walk that. They've got the experience that they bring to the table. They're not emotionally involved. They're not even the one swinging the club. And so they're looking at that and they're understanding it. And what they're doing is giving great direction. Trust the club. If they tell you, to use a 7 or use your pitching wedge, you just got to trust
Right.
they know what they're talking about. And will you hit it right every time? No. But the odds of hitting it, the probability of hitting it successfully, taking that guidance and that coaching is dramatically better. So I think one of the things we have to do, trust the tools that are in place already. Don't let your eyes deceive you. Don't let the crowd around you. And so don't get distracted from what the game is. And the game is, hit the ball straight, get on the green, get better at putting the short game. And the other thing I think that is true of investing and golf is patience.
Yeah.
I really think that a lot of times what happens, like whether it's a great golfer or an amateur golfer, that in patience thinking that, you have to make everyone the best one. And those who have had experience, what you want to win is 70% of the time. So a lot of what we think about is, can we get 70% of the return of the equity market we're exposed to by being greater diversified and therefore reducing the risk? And can we do that at a lot less volatility so that we can mitigate that? And we do it, like Nick said, by having most clients have 2 strategies or more, where they've got a short game, if you will. This is the safer bucket, and the longer one that can make up for the things that are going to happen in the short game, which is the long-term performance. We have to beat taxes and inflation, to Nick's point. So there's a lot to this analogy. One of them is you are going to be in the rough sometimes. A matter of fact, like Nick said, 14% or more of the year is negative.
Right.
And there's 25% or so of the time the market's down substantially. That's 1 every 4 years. So even though it might feel different today, we have to trust the tools, make adjustments, not based on sensation, but really, again, use the right club and trust the guidance. You'll be right more often than not.
And Randy, if I could you maybe even dive into like factually, what are some recent things that we've done and things that maybe even be a consideration today?
Yeah. So, our firm, we've taken the approach that we want to be right in our trades. And so one of the things we're very careful about is our taxable accounts.
Not guaranteed.
Oh, yes, absolutely. But one of the things we want to do is we want to mitigate taxation wherever possible. And sometimes, you do have to pay taxes in order to properly position a portfolio. But we don't want ongoing everyday trades and transactions. So our taxable accounts are already designed to weather whatever storm comes. So we very rarely, 2022, we took more dramatic action. It was a really bad year, both in fixed income and equities. And so we were able to mitigate a lot of losses there by making changes. Not guaranteed. But the retirement account portfolios, first, early in the month of March, we de-risked them quite a bit. And we have a strategy that includes a seasonal or calendar type of trade, which we recently entered. And it was really difficult to enter that. And I'll just be real brief on this because of the tariffs. And what's interesting, the first couple of days that we entered that trade, the market just crashed. And, of course, your gut instinct and that intuition kicks in, I knew better, et cetera. And then the last 2 days, which should be the worst 2 days, when you're really on pins and needles, have been okay, maybe even good. So the market already has built in how much risk. In other words, where we're seeing pricing today, knowing that, as you were joking earlier, that tariffs are already known by everybody, and especially institutional money, which does much of the trading, how much of the volatility has already been priced into the market.
Right.
And so right now, as we end the day and go into tomorrow, it'll be interesting to see, were the tariffs worse than expected, better than expected? Was that already priced into the market? And nobody knows. Let's be honest. Nobody knows. But the market will respond. So not only do we have a trade on right now, which is reintroduce some risk, which we will take off the table in a couple of days. I can't tell you exactly when. I know when it is, but I don't want to violate anything.
Right.
But we're going to have a couple of days here where we're going to find out which direction the market is headed. Is it heading more bearish, or are we back where we can, we're back on the green and we could play our normal game? So with our retirement account strategies, we're more nimble, risk off, risk on. We try to do an all-weather type of strategy with taxable accounts to mitigate once those portfolios are set up and we've already paid the price, so to speak, to allocate them to the positions that we want. We want those things to be able to ride through any markets. I don't know if that helped you or not.
Oh, it was very helpful.
I was just hoping we could mute so we could hear the good stuff that we can. I had a longtime client that was with me the other day, and I could tell they'd been with us a long time because their response when they were kind of asking about the market, they're like, I know. You're getting the information that you're making for trades off of a laptop and not a crystal ball. We're like, hey. And I think that's important. If this isn't a gross, boil down, adopt a plan. Remember, in a moment like this, you have a plan and stick to the plan.
Well, and trust your caddy. Trust your coach.
Right.
I think
right.
They've played the game a lot. They've got a lot of experience. They're in that position. You might be a better golfer in your own mind than them, but I tell you what, the right coach can guide you through the stuff, especially to remove the mental stuff that we all know that we have.
I've got this happened. You were with me. I think I had played with a caddy one other time in my life, and we were playing at Pelican Hill. This is years and years ago.
Many years ago.
In Newport, California. And Aaron, it's this gorgeous, gorgeous golf course. You're overlooking the Pacific Ocean on several of the holes,
Yeah.
and it's beautiful.
Right.
The wind is hitting you strong. We have this caddy who's guiding us. Okay, so it looks like I should be hitting to the left. Okay.
Yeah.
And I, 7-iron, 5-iron, whatever it was, right? Hybrid to the left. And the caddy comes up and says, no, you're going to hit towards the cliff. As a matter of fact, you're going to hit it as hard as you can towards, I said, the ball's going to go over. He says, no, it's not.
Yeah.
And I said, no, if I hit it I'm hitting it into the wind. And he says, do what you want. I'm telling you, hit it that way.
I'm here every day.
Right? And I said, okay.
Yeah.
So got my club out, and I swung. I hit the ball,
Yeah.
okay? And sure enough, that wind comes off.
Carried it right
And
there.
it carried it right where it needed to be in the fairway. So taking that advice from that expert helped me to make a better move with my ball in my position. And I'll never forget that, because it was so, you ready for this word? Counterintuitive.
Right. And the thing to know about that too is that was one season, one day, one hole. It doesn't always work.
Well, and that's right. Seasons
Yeah.
change, winds change.
Yeah, no,
Yeah.
that's so true.
Yeah.
Speaking to that, Nick, you and I were playing golf not too long ago, and it's going to be shocking. I hit it a little bit into the woods,
No.
and I told
Hold
them
on a little bit.
it was okay. It was I could have very easily got back on, to where I wanted to be. My point for bringing this up, and I don't know if you know this or not, I saw you and our client that had played ahead because it dog-legged around. I could see y'all through the woods. And impulsively, I had this moment where I thought, if I were to turn, if I could rocket it straight through, I'd be caught back
Miss
up, and
all
I would
those
say,
trees.
yeah, I would, now it would be really hard to do, but if I did it, I mean, imagine the strokes I would shave off. I'd be caught back up. You guys might all of a sudden think I'm a competent golfer, which is not the case. That's kind of a moment that you can be in different times, where you could look at that impulsive opportunity and it can look appealing. And I feel like that kind of dives into emotional investing, which is one of the areas that we wanted to hit. Nick, would you cover that for us?
Yeah, I think we've all heard, terms like, you buy low, sell high, but the average person wants to do what? They want to sell low and buy high, right? I want to sell it now because it hurts, it's painful, I'm scared, and then I'll wait for it to recover, and then I'll buy.
Right.
And, it's akin to me really wanting, let's say, a new set of golf clubs, right? And I go in the store, and since they're all brand new, they're priced, 10, 15% above, what it should be priced. Well, do I want it bad enough that I'm going to pay that? I'd feel like a fool with my money. So absolutely not. So then I'm going to wait for it to go on sale. Well, now do I buy them when they're 20% off? Do I wait to see if they go 30% off? Do I wait till, they go 30, 40, 50%? When do I make that decision? Because I'm certainly not going to pay 15% overprice. But that's what we do with our investments. We're willing to pay more than, because it feels good. I've got the new set of clubs. I've got the new investment strategy, and everything's good and happy. Yeah. But the reality is I want the discount because it's the same exact club.
Yeah.
Right? But I want the discount. We just have a hard time translating that into our investments, but the same reality applies. And I think what we have to remember when we're doing something that is extremely highly technical, like what we're doing right now with our portfolios, we have to be extremely mindful. You have to be right twice, not once.
Yeah.
We've got to be right when we maybe de-risk the portfolio and move more towards cash or bonds. But then we've got to be right again when we re-enter and make that next purchase. Mm-hmm. So many people are willing to exit at a certain price, but they have no repurchase or re-entry strategy. So you might have been right once, but if the portfolio or the market goes back up and you're buying here, it didn't really matter. So you got to be right twice. Yeah. And I think it's really, really hard for an amateur investor to be able to do that. Sure. So that's why you'll never hear us invest based on what could, should, or would happen. Yeah. We're always going to invest. It's got to be technical, and Randy coined a term years ago, fat base, which you might get into a little bit more in a minute, but what are the facts of the market? What is actually happening? What do the technical indicators say? And that's why we're going to follow what I call the math.
No, I like that. I think what would be the equivalent there is sometimes that person would get frustrated, and the next thing you know, that club goes sailing into the water hazard. What we want you to do is resheath that club and seek wise counsel. Reach out to that financial professional.
Don't break your club.
Yeah. Because then there's another cost to the and that's always the thing. It's like, you make that impulsive mistake, then that frustrated response, and now there's even more costs associated. One of the things that I think you hit on when you were talking about you guys playing out west, even the highest level, most elite golfers consult a caddy because they realize, one, sometimes it's that opposite perspective. I love when they're making the rounds and consulting and they're looking from different angles, or if it's a local, professional that knows that course. And to your point about saying, hey, this is deceptive in the way that it's looking, having that coach, having that second opinion, having that caddy, it's so important. And since we've just encouraged that, Nick, would you kind of talk about how, especially, in a moment like this, a coach is possibly, more relevant than ever?
Yeah. Well, I think about from a golf perspective, I've played a lot of charity events, and a lot of the charity events happen to be best ball. Okay. So if I'm on a foursome, we're all going to have 4 hits perhaps on the same ball. And what you typically do, like especially if it's off a drive, you're going to let somebody try to play it safe up front, so you've got a playable ball, but your big hitters you're going to put in the back so they could really go for it at the end. Or if it's a putt and you're not exactly sure, is there a slight, like, what is that edge? And you're trying to determine the line to the pin. Well, typically you let that first person hit towards the pin, and it's going to go, club high, club low, or whatever. But that alignment helps the next golfer and the next golfer and the next golfer try to sink the putt. And what
it was years before I realized, when you sent me out first and said, hey, Calhoun, you got this, show what we got, that I realized you wanted to figure out what was slow on the uptake, and I'll never forgive you for that. Sorry, Nick, go ahead.
Crap, you figured it out. But in the same way, what you're looking for is a guide. You're looking for somebody who's done it over and over again. They've played maybe the same course, and they know what that lie is. Yeah. They already know what it is. And I think when you are thinking about getting a second opinion, what you're saying is there might be somebody else who's had a different experience going through the waters like these. Yeah. If this is the biggest asset in your life,
your retirement accounts,
why would you not get a second opinion? I think that's just wisdom. I think that's sound counsel. As a matter of fact, I was talking to a gentleman recently, and he was talking about a procedure he thought he was going to have. I think it was either his elbow or his shoulder, but he went to 3 different orthopedics before he made the final decision of what he was actually going to do. And I think that's just a wise thing to do, is to get that second. And, in periods like this, Aaron, and this isn't meant to be self-serving, it's just reality for our firm. This is our 30th year in business. In down periods and volatile periods like this, our firm grows. And it's because we have we're almost inundated with people coming in wanting a second opinion because of the lack of confidence they have with their either current professional or their current strategy. So I think that's a wise thing to do. And I think right now is probably as good a time as ever with taxes coming due.
Can I just an interesting observation when I was hearing you talk. The psychology of investing and advice is really interesting to me. So you could have like a really bad caddy, and what they do is you come to them, or your caddy's there with you, and you say, what I think I should use is a 9-iron and do this, that, and the caddy goes, that sounds great. and what you could feel is that caddy gets me. He understands me.
Yeah.
But you don't want that caddy. You want the caddy to do what your caddy did, which you said, no, are you a nut? Don't use that. Use a 6 and don't shoot here. Shoot here. Can you not feel the wind? Like, so a lot of times in the advice business, what I've noticed is people can be very happy with the advisory team because they're just listening to them. When what they're doing is like going to Burger King, have it your way.
Yeah.
So even what you want is a combination of competence and a good bedside manner. But take the competence first. Take the caddy, might not even have the best bedside manner, but they've played the course, they know what they're doing, they've got a probability of success. And in this industry in which we work, investing in general, you want to win 70% of the time. If you go for 100, you're going to be so anxious. And one of the things, again, going back to that psychology today, is everybody's measuring things on such a short time frame that a properly diversified portfolio, a properly diversified asset strategy, where you've got multiple strategies working on your behalf, they're not going to perform the same. That's intentional and by design, but those get you through the rough. They keep you out of the water, and then you've got a winning strategy, and it doesn't have to win every time. So I've read quite a bit about this, as you guys are aware. And one of the things I've noticed about the absolute best professional managers of money in the industry, and there are not a lot of them,
Right.
but the very, very best, they have one thing in common: super patient. They are willing to ride through rough waters, bad times, bad hole, a bad game, whatever it might be,
Right.
to win in the long haul. And I think the other thing they're willing to do sometimes is take risks that other investors won't. And one of the things that the public has been taught, and I think it's an injustice, is that as you get older, you must get super conservative. Nick, you made a point. We're living a lot longer. As a matter of fact, 30 years longer than we did 100 years ago.
Right.
So we're living longer. Our money has to last longer. And today, we're not just living on Social Security and a pension. Most of our clients have personal assets. And so what we want to do is help them properly steward that. And sadly, most of us have never been educated about investing, even though that investment responsibility has largely been put into the 401k market from the defined benefit market. So what we have to do is meet people where they are, where their game is right now, how they're playing, and help them tweak that game so that they can win more consistently. And I think that's a tremendous responsibility that we have, in addition to the things you're referring to, Nick, like smart taxes, being smart about how taxes are played, like Roth conversions and donor advised funds and QCDs, all of those little cool techniques that somebody might learn after they've got the basics. But find the right coach, sometimes get a second opinion, and I think you're going to win more often than not.
Yeah, no, that's great advice. It really is. It's so easy.
Aaron, Tanya from Holly Springs, Georgia said, "Thank you for sticking up for all the putt-putters."
You're welcome, Holly.
Putt for the fun of it, I say.
For the fun of it. I think that I love that.
That's amazing.
I love that so much. But I think for a lot of us, I'm going to use that for a second.
Yeah.
Some of us need to start with putt-putt.
Yeah.
Before we jump on and play 18. Mm-hmm. And there's nothing wrong with that.
Nothing wrong with it.
If the majority of your assets during your working life, it was all built towards accumulation, grow, and you had some target date funds, or your 401k had like 5 options or 20 options, and that's all you had, you're playing a game of putt-putt.
Yeah.
But that eventually becomes a very, very serious asset. And when that's a serious asset, you don't invest in your retirement life the way you did in your accumulation life. It's a completely different game.
Yeah.
And now you've moved to 9 holes to 18 holes.
Right.
So the strategy, the thought, the strokes, the technique, everything has to change.
Yeah. No, that's so good. All right, Nick. So for everybody that was with us today, let's treat the next hole like a par 3. Give me those 3 strokes that we want to leave with. 3 key takeaways for today's episode.
I think number 1, we've got to stay the course. Okay? If you've got a plan in place, work your plan. Okay? You don't change plan because things don't feel good. Okay? If you have a plan, stick to your plan, because you had a plan put in place with the thought and consideration that bad times would come. Your plan already addressed those things.
Nick, can I interrupt you for a second?
Yeah.
I agree with what you're saying, but the reality is many people, maybe even most people, do really not have a plan.
Yeah.
Their plan goes back to a former episode of luck.
Yes.
And this is not a game.
Luck is not a plan. Hope is not a
Luck is
plan.
not a plan.
We got
fear is
a
not a plan.
backlog that they need to check out.
No, I think that's a really fair observation. In having a second opinion on your plan that you have, I mean, if you do have one, is a wise thing. But I think, Randy, for many of our listeners and watchers today, if they've worked with us, they've got a financial action checklist, they've got a game plan. So for those people, it's sticking to your plan and staying that course.
Yeah.
And then I think number 2 is implementing. For those that are not clients, our general audience, if you don't have a portfolio structured for different times in your life, such as, we kind of put it as a now, later, and future portfolio to address, times of volatility and then times where you're going to need it for taxes and inflation, you really want to reconsider what is that portfolio makeup to get you through retirement successfully with those 30 extra years.
Well, and with highest probability.
Yes,
Yeah.
yes. And then third, I'd say get a second opinion. If, again, you're a part of our general audience, you've had somebody who's made a recommendation to you, maybe you've gone to one of those dinner seminars where they try to sell you 1, 2, or 3 annuities. Sorry, that's a little...
Yeah.
But everyone's got their thing. What I'm simply going to suggest is that there is nothing wrong with getting that second opinion. So those are the 3 things.
No, that's absolutely fantastic. And before we sign off, I just want to make sure that everybody just, we had a lot of fun today, but the reality of it is the golf game is very similar to our financial retirement plans. We want to make sure that we are seeking wise counsel, that we've got those coaches, those professionals that we're looking towards. Want to make sure that we've got the right strategy, that right plan in place. And that's how we successfully go through this game, this life. We hope as a podcast, as a live stream today, to continue to be a resource as the retirement coaches. But again, if you've got a specific question, if you've got something that you want to drill down on and you want me to put something in front of the coaches, reach out to us. We want you to email us at connect@yourretirementcoach.com. You can even call us locally if you want to, 770-427-5227. Please let our director of first impressions know where your impressions came from. But again, the big thing that we want you to do is just keep staying coachable. We'd love to see you subscribe to the podcast, interact with the podcast, give us things that we can do to kind of help make this a broadcast in whatever format you consume it, a way to help people prepare for retirement, retire often, and succeed in their retirement. And as I said just a minute ago, on behalf of our coaches, stay coachable. We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@yourretirementcoach.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. On behalf of our coaches, we want to thank you for listening and for being coachable.
Yeoman's Consulting Group, a registered investment advisor YouTube channel based in Marietta, Georgia. We strive to provide comprehensive wealth management services for every stage of the journey. This platform is solely for informational purposes and is not offering advisory services or sales of securities. Investing involves risk and possible loss of principal capital. Comments by viewers or recognitions are no guarantee of future investment outcomes and do not ensure that a viewer will experience a higher level of performance or results. Public comments posted on this site are not selected, amended, deleted, or sorted in any way. If applicable, certain editing of personal, identifiable information and misinformation may be deleted. The opinions expressed herein are as of the date of publication and are subject to revision due to changes in the market or economic conditions and may not necessarily come to pass.